We're seeing a big rally in the markets in recent days, lifting the S&P out of correction territory. However, right around the time this rally started, you actually lowered your S&P target. Give us a sense. You're known as a bull. What led you to do it?
We just wanted to right-size our target after that 3-month correction that we'd had. And so we were at 4,900, which we had gone to as I recall, at the end of July. And then we changed it. We went to 4,400 after that 3-month correction that we saw. And our expectations are that 4,400 is very likely to be exceeded by the end of the year. But it's a little bit late. I don't know if we're going to try to adjust this target. The biggest problem we think for the equity market here is our expectations for 3 to 4 cuts next year. And we think it's likely the Fed won't begin cutting until the fourth quarter of next year. So it just means this market could be tested, but we remain positive on equities.
Okay. So you're looking already ahead to next year. I want to talk about this quarter right now. So according to your data, about 94% of companies have reported their earnings. EPS, 3% higher year over year. Isn't this the boost that justifies some of the rally that we're seeing? I mean, earnings actually moving to the upside, or do you disagree?
No, we think absolutely. We're very positive on the earnings. And in fact, we'd point out that 8 of the sectors as of last Friday were showing positive gains in earnings. Only 3 were negative. They were energy, materials, and one that I can't think of at the moment. But my point on healthcare, are you ready for that? But so what really has been positive here has been that we've 8 out of 11 sectors positive earnings growth, very modest revenue growth, but a lot of that to be expected with the Fed remaining in a hike mode. Although we don't think they're going to move higher, we think they will maintain rates around this level through next year.
All right, I do want to drill down on actually a sector. We're looking at one of them right now, the S&P consumer discretionary sector. We have a lot of retail earnings coming up this week. Dick's Sporting Goods before the opening bell. Now, according to your data, consumer discretionary is trading just below its 5-year average. Does that make it attractive right now as we see better than expected earnings and we continue to see the consumer spend, especially into the holiday season?
We'd have to think so, Frank. When we look at it, consumer discretionary, represents a large part of GDP. I mean, the consumer is about 70% of GDP in the U.S. And so when we look at that, we can't help but think that we've seen significant resilience in terms of the consumer. If anything, it perplexes the bears very much. And already we've seen very good results from many names in retail. So our expectations are here that we could see more surprises this week. And we think it's tech, it's consumer discretionary, and industrials that are our favorites at this point in terms of the sectors.
You know, John, I want to go back to something you said in the beginning. You said you lowered your price target. It's now 4,400, but you said you might try to make a change. It sounded like you had some wavering in your voice. So give us a sense, what you've seen from this rally, what you're seeing from earnings with 94% of companies reporting. Do you think you're going to raise that price target again?
Well, we'd have to consider it, but it's a little late in the year. Our 4,400 target we'd originally put in last December, and the market went through that in late June, as I recall. And that's when we went to 4,900. Then we made the adjustment afterwards, after that 3-month pullback really looked like the bears were going to hold us hostage here like they did in the fourth quarter of 2018. But they didn't. So,
right.
but it gets, the most important thing is it looks like it's a positive environment for stocks with fixed income, highly complementary, but not really competitive to the potential that stocks have here.